Hello, everybody. This is J.R. Humphreys, and I am responsible for the preferred income strategy here at Sheaff Investment Advisors. Today, I'm going to talk a little bit about preferred securities and why next year might be the year for this asset class. Why preferred securities? Well, there are several reasons that I'm going to go through. The first one is that preferred securities have very rarely had negative years. In this chart for the past 32 years, starting in 1990, preferred securities have returned negative returns in 7 of those 32 years. And when they do have a negative return, usually the next year is pretty strong performance, with the one exception being the 2007-2008 period, when the recession as a result of the banking crisis and mortgage defaults led to 2 back-to-back years of pretty significant negative performance, followed by several years of pretty strong performance. And the reason that happened is that recession, the epicenter was the banking industry. And banks are the largest issuers of preferred securities. So it makes sense that a recession, a very hard recession led by banks, would impact preferred securities pretty dramatically year after year. What's going on now is, one, the Fed is currently trying to break the back of inflation, and it looks like, according to the 5-year break-even inflation rate, the Fed has pretty much succeeded in that. If you look, this is the 5-year break-even inflation rate, which implies what market participants expect inflation to be in the next 5 years on average, and that's around 2.5%. To do that, the Fed's hiked rates pretty quick, and we're looking at them stopping probably this year, probably in the middle of the year. The chart here is what's called the market implied policy curve, and this is what market participants voting with their dollars in the treasury market are showing, where they feel the Fed funds rate will peak out at about 4.9%, and then at the end of the year the Fed will start cutting. Now, this is what the market participants are saying. The Fed, on the other hand, has mentioned taking the rate up to 5.25, and then holding it for a longer period of time. So this will be interesting to see what happens in the future to Fed policy rates. As a result of the Fed increasing rates, we're now seeing some pretty good yields available to preferreds. They are attractive both on an absolute basis and relative basis relative to other fixed income investments. If you look at the yield to maturity, preferreds are in that 6 to 7% range. And this was taken about a month ago. They've fallen a little bit as yields have increased, as prices have increased. But we can still get comfortably that 5 to 6.5% range. Corporate bonds, you can see in that 5%, and municipal bonds at 3%. So that's how they compare relative to each other. Now, on an absolute basis, if you look at where they trade versus their 10-year average, not too bad. We haven't seen rates this high probably in the last 15 years, if you take out the 2007 period, after the 2007 period. Anyway, we're seeing 10-year rates on average of 5.4%. Now, 2007, 2008, if you remember, we had back-to-back negative years, and that was in the banking industry. And if we had one risk to this scenario, is if there is a very severe recession that impacts banking, impacts credit spreads across the board. The credit spreads are just that extra amount of return bond investors, preferred investors need to tie their money up. So here you can see this is the capital ratio of major banks. And due to what happened in 2007, 2008, capital ratios by law and regulation the banks were required to increase that. So as you see, 2007, 2008, we were looking at capital ratios around the 4 or 5% range. And today they're around that 11, 12% range. So banks are well situated to make it through a recession, severe recession. They should do okay, I would think. but no one is really calling for a severe recession, just a recession. So that's our case for preferreds next year. We'll see what happens. It kind of works like this. If rates start coming down, preferred, you will get the return of the carry or the coupon and any principal appreciation. Now, if the Fed keeps rates high and keeps them for longer, and we don't see a decrease in interest rates, then the coupon may be all that you receive. And at the current yields of, that 5-6% range, you'll still do okay. Okay, that's it for today. Again, this is J.R. Humphreys. Thanks for joining us.